Every year, the tax office tells us more or less openly where they're going to be looking at, including what industries, what clients, and what kind of arrangements they're pointing at. And this year, they have been given close to $1 billion in funding to go and do that. Reading that list and working out which of my clients are affected is part of my job. So I spend time with it that a business owner running their own business day to day generally wouldn't. This year, the list is worth paying attention to, and not just what, but why. Because knowing what actually sets the alarm is what gives you the chance to fix something before later turns up instead of after. The first thing to understand is that audit almost never starts with a person. It starts with a computer. Years ago, the tax office would more or less pull a name out of a hat. Someone would get picked, an auditor would come out, and half of the time they found nothing. That's not how it works now. Now, the data match. So your bank feeds, your payment platforms, and your asset registry all gets pulled together and compared against what you are reporting. And on top of that, they benchmark you against other businesses like yours. If a cafe in your area is running at a certain margin and yours is reporting well below, the system notices it, and eventually you get a letter that says, in so many words, please explain. So being flagged doesn't mean you've done something wrong. It means your numbers don't stack up against the computer's expectation. And now a human is going to have a look at it and understand why. The other things that changed, and this one matters, is what happens once you're actually behind. It used to be that if a client falls behind or made a mistake, you could ring the tax office, explain the situation, and more often than not, get the penalties and interest get knocked off. That's largely gone. Now it goes through the portal, it gets assessed, and a lot of time, the answer is no. I've got a client who did almost everything right. He had proper accounting software, the bookkeeping was up to date, he paid his staff on time, even paid his super on time, paid all his invoices, and kept money aside for all his ATO liabilities. On paper, he's exactly the kind of business owner you would think would never have a problem. But the one thing he didn't do was lodge. 3 full years went by without lodging a single BAS. He had the money sitting there the whole time. He just never got around to actually filing, and that's what triggered it. 36 months of nothing from the tax office side looks exactly like someone is avoiding them. So an audit landed. It had nothing to do with a dodgy client or being caught by benchmarking. It was simply that he had gone quiet. He ended up going back through 3 years of records to prove what should have been straightforward all along. And he paid penalties for late lodgements on top of it, even though every dollar owed was sitting there ready to go. It's one of the more frustrating ones I've seen because money was never the problem. It was the lodgements. And one more thing worth knowing before we get into any specifics. When they do look, they go back several years. So review that starts this year isn't limited to this year. So with that as a backdrop, here are the specific areas they have told us they are focused on for growing businesses. The one that catches the most owner-operator is using company money for personal things. When your business is going well, it's the easiest thing to treat the company's account like it's your own. The company pays for something private here, covers personal expenses there, lends you some money informally, and on its own, any of this feels harmless. The problem is the tax office treats money that comes out of a company to benefit you personally as something that has to be reported and taxed properly. And when it isn't, that's where it gets characterized as income you should have declared. This is squarely on their list for this year. They have said plainly their focus on arrangements where company money or assets are used for personal purposes without being reported and taxed correctly. The fix isn't complicated, it's just discipline. Keep the business account and personal account genuinely separate. And where money does move between you and the company, make sure it's documented and treated the right way. The single most common place that the line gets blurred is the car and the vehicle claims are high. on the list this year. The car is the one almost everyone assumes is a safest claim, and it's become one of the easiest for them to pull apart. If you bought a vehicle through the business, it feels completely reasonable to put most of down as business use. You do use it for work. So you claim it at 80, 90%, and you don't think about it again. The trouble is that the car leaves a trail in place you are not thinking about. The registry has it sitting at your home address every night and every weekend. The insurance is written for private use, and the logbook that's meant to back the percentage up is either a year old or was never kept at all. None of that used to matter much because no one was cross-checking it. Now it's one of the most heavily data matched claims going. So the gap between the percentage you have claimed and the picture the data paints is sitting right in front of them. And a claim you thought was the safest one turns out to be the easiest to disapprove. The rule hasn't moved. You can claim the business portion, and you need the records that show what that portion actually is. So if your logbook is more than 5 years old, or you have been claiming a business percentage without one, that's the things to fix now. While it's a tidy up job and not an answer you're given under review, cars are only one of the assets those registry show them, which runs straight into the next one. This next one is one people find out more surprising because it isn't about the number on your tax return. It's about the gap between how you live and what you have declared. The tax office matches data on big assets, boats, expensive cars. That sort of things gets recorded in a registry, and the tax office can see them. So when someone reporting a modest income but has bought a boat, a couple of cars that the income couldn't obviously pay for, the gap gets noticed and they want to understand where did the money come from. For business owners, this catches you in a particular way because often the assets was bought through the business or a related entity, and if it hasn't been handled correctly, you're back to the same territory as a personal use problem from earlier. Money coming out of the company for private benefits. None of this means you can't own nice things. It means the income that's paid for them needs to be visible and declared so that when they look, the picture actually adds up. Trusts are on the list too, and for similar reasons. The tax office is paying attention to trust distributions that don't sit right. That covers distributions to a family member on a low tax rate when the actual benefit ends up somewhere else, and distributions that go outside the family group and trigger a tax most people have never heard of. The common thread is arrangements where the paperwork says one thing and the money does another. Again, this is a topic we have covered on its own because there is a lot happening with the trust at the moment. So I'd point you to that video for the details. For the purpose of this one, just know that a trust isn't a set and forget structure. The distributions have to be done properly every year, and done properly means the paperwork and the actual flow of money lines up. If they don't, that's what draws attention. That covers the structure side of it. The last to come down to routine and compliance. GST is the one that tends to get set up once and then never looked at again, which is exactly why it's worth a look this year. They're watching both ends of it. The first is the registration. As the business grows, it can cross the turnover threshold where registering for GST becomes compulsory and just carry on as it was. And that's the kind of things that data picks up now. The other side is a business that is registered but doesn't look like it's actually running an enterprise, which gets attention for the opposite reason. The second end is what you are claiming back. And that's where growing businesses get caught because a bigger business makes bigger claims. A large GST refund with no valid tax invoice behind it is one of the most common reasons that gets knocked back. Or worse, paid and then clawed back later once someone looks at it. The last one is around your super obligations. A shortfall in what you have paid into someone's fund used to be able to sit there unnoticed for a long time, but that's changed. Single touch payroll reports what you say you have been paying. The funds report what they have received, and the two gets compared almost straight away. So a gap shows up quickly now instead of sitting there for years. The other part is how you classify the people you pay. When you're growing and you bring someone on, it's tempting to pay them as a contractor rather than put them on payroll. Sometimes because it's simpler and sometimes because it works out cheaper. But whether someone is a contractor or an employee isn't decided by how you choose to pay them. There are tests for it. And if a person is working like an employee, then that's what they are. And the super was owing the whole time. The last part is what makes getting it wrong expensive. On top of the back super, you should have paid them. There are penalties as well. So it's worth getting the classification right at the point you first take someone on. Say you get a letter from the ATO, despite getting everything right on the list. The first thing to understand is that the letter is not an accusation. As I said at the start, most of the time, it just means your numbers don't stack up and have fallen outside the range, and someone wants to understand why. So the worst thing you can do is panic, ring the tax office yourself, and start trying to explain things off top of your head. What should happen is your accountant goes into your file first before anyone responds and works out what actually triggered it and whether there is a genuine issue there or not. A lot of time, there isn't. You claim something that was legitimate. You have just got to produce the records that back it up. And that's the end of it. Where there is something that needs sorting, it's a lot better that you and your accountant find it and get ahead of it than that you go in blind. The reason to have someone across it is the enforcement I mentioned earlier. Once penalties and interest are on table, it's hard to get them off. So how the response is handled from the very first letter actually matters. So none of this is about being frightened of the tax office. It's about knowing what sets them off, keeping your own house in order, and having someone who knows what they're doing if a letter ever does land. None of the areas on this list are worth losing sleep over on their own. What matters is that someone who knows your situation has actually looked at them before letter does. If you're a growing business and you are not certain everything is sitting the way it should, get in touch with us and we will go through where you actually stand.